The evidence is mounting. Central banks just crossed a threshold that hasn't been seen in modern financial history, and if you own gold right now, you need to understand what's happening in the next few months. Over 1,000 tons. That's how much gold central banks have been accumulating every single year for the past 3 years. To put that in perspective, the historical average was 400 to 500 tons annually. They've more than doubled their buying pace, and they're not slowing down. This isn't speculation. This is documented, verifiable data from the World Gold Council, and when you dig into who's buying and why, the implications become crystal clear. Let me walk you through what's really happening behind closed doors at the world's most powerful financial institutions, because the countdown to a major market shift is accelerating faster than most people realize. The first thing you need to understand is that central banks don't make impulsive decisions. These are institutions that plan decades ahead. They have access to economic data and intelligence that you and I will never see. And right now, they're making a coordinated move that signals something fundamental is changing in the global monetary system. China's been leading the charge. Month after month, they're adding to their gold reserves. But here's what makes this interesting. They're not just buying gold. They're simultaneously reducing their holdings of U.S. Treasury bonds. That's not a coincidence. That's a deliberate strategy to diversify away from dollar-denominated assets. Poland, another major buyer, increased their gold reserves significantly. The National Bank of Poland has been vocal about this strategy, stating publicly that gold provides stability in times of geopolitical uncertainty. When central banks start making public statements about their gold buying, that's when you know something's shifted. India, Turkey, Singapore, the list goes on. These aren't small players. These are major economies making strategic decisions about the future of their monetary reserves. Now you might be thinking, okay, central banks are buying gold. They've always held gold. What's different now? Here's what's different: the scale and the urgency. In the first half of this year alone, central banks purchased 415 tons of gold. Even though that's down 21% from the same period last year, it's still massively above historical norms. And here's the kicker. They're doing this while gold prices are at record highs. Think about that. These institutions are paying premium prices because they believe gold is going even higher. When was the last time you saw central banks aggressively buying an asset at all-time highs? It doesn't happen often. And when it does, it's because they see something coming that makes current prices look cheap in comparison. Let me paint you a picture of what's driving this behavior. The global monetary system is under stress. We've got inflation that's proven far more persistent than anyone predicted. We've got geopolitical tensions escalating. We've got the BRICS nations actively working to create alternatives to the dollar-dominated financial system, and we've got debt levels in major economies that are simply unsustainable. Central banks see all of this. They're not reacting to headlines. They're preparing for structural changes in how the global economy functions. Think back to 1971. That's when Nixon closed the gold window and ended the direct convertibility of dollars to gold. It was a watershed moment in monetary history. The world moved to a pure fiat currency system backed by nothing but faith in governments and central banks. For decades, that system worked. The dollar remained the world's reserve currency. International trade was conducted in dollars. Countries held massive dollar reserves because they needed them to participate in the global economy. But something's changing. The trust that underpinned that system is eroding. When Russia was hit with sanctions and had hundreds of billions in dollar reserves frozen, every other nation on Earth took notice. If the U.S. can freeze Russia's reserves, they can freeze anyone's reserves. That's a risk central banks can't ignore. Gold can't be frozen. Gold can't be sanctioned. Gold doesn't depend on any government's promise or any central bank's policy. It's the ultimate neutral reserve asset. That's why you're seeing this unprecedented accumulation. Central banks are hedging against a future where the dollar's dominance isn't guaranteed. Now, let's talk about what this means for the gold market itself, because the mechanics here are fascinating. The gold market operates on two levels: the physical market and the paper market. The paper market, dominated by futures contracts and ETFs, is where most of the price discovery happens. It's massive, liquid, and it's where traders and speculators play. But the physical market is where the real action is. That's where central banks operate. That's where you see actual gold bars moving from vaults in London to vaults in Beijing, and the physical market is much smaller than the paper market. Here's where it gets interesting. When central banks buy 1,000 tons of physical gold annually, they're removing that gold from the available supply. It goes into vaults, and it doesn't come back out. Central banks don't sell gold unless they're in a crisis. Meanwhile, the paper market continues to trade as if there's unlimited gold available. Traders buy and sell contracts representing gold that may or may not actually exist in physical form. It's a fractional reserve system, just like banking. This creates a disconnect. And when that disconnect becomes too large, the market corrects, violently. We saw this play out in the silver market back in the day. We've seen it in other commodities. When physical demand overwhelms paper supply, prices don't just rise gradually, they spike. And right now we're watching physical demand from the world's most powerful buyers accelerate, while paper markets continue to operate as if nothing's changed. Let me give you some context on what happens when this dynamic plays out. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's dollars. What drove that spike? A combination of inflation fears, geopolitical instability, and a loss of confidence in fiat currencies. Sound familiar? The difference is, back then, central banks were sellers of gold. They were trying to suppress the price to maintain confidence in their currencies. Today, they're buyers. They're competing with private investors for a limited supply of physical metal. That's a fundamentally different market structure. In 2011, gold hit $1,900 an ounce during the financial crisis aftermath. That rally was driven by quantitative easing, zero interest rates, and fears about the stability of the banking system. But even then, central bank buying wasn't at the levels we're seeing today. Now we're in a situation where gold has broken through previous all-time highs, and instead of profit-taking, we're seeing accelerated accumulation from the world's most sophisticated buyers. Quick aside here, because this is relevant if you're thinking about your own financial security. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical gold into those accounts without triggering tax penalties. I put together a free guide on how gold IRAs work. It's in the description below. Covers the mechanics, the rules, the pros and cons. Worth checking out if that's relevant to your situation. All right, back to what's happening in the market right now. The third quarter data showed central banks adding 220 tons, even as gold prices were hitting record highs. That's significant because it shows price sensitivity isn't a factor in their decision-making. They're not trying to time the market. They're accumulating regardless of price because they're focused on long-term strategic positioning. Compare that to private investors, who tend to buy when prices are rising and sell when prices are falling. Central banks are doing the opposite. They're buying consistently, methodically, without regard to short-term price movements. That kind of buying creates a floor under the market. It means every dip gets bought, every correction gets absorbed, and over time, it pushes prices higher because supply is being permanently removed from the market. Now let's talk about supply, because this is where the story gets even more interesting. Gold mining production has been relatively flat for years. The easy gold has been found and mined. New discoveries are rare. Existing mines are getting deeper and more expensive to operate. And the time from discovery to production for a new mine is measured in decades, not years. So you've got flat to declining supply from mining. You've got central banks removing 1,000 tons annually from the market. And you've got growing demand from private investors who are watching the same data and drawing the same conclusions. The math doesn't work. Something has to give. Either prices rise to the point where demand is destroyed, or we see a supply crisis where physical gold becomes difficult to obtain at any price. We've already seen hints of this. During the pandemic, there were periods where premiums on physical gold coins and bars spiked dramatically. Dealers couldn't get inventory. Mints were running at capacity and still couldn't meet demand. The paper price of gold was one thing, but if you wanted actual physical metal, you paid a significant premium. That was a temporary disruption, but it showed what happens when physical demand surges and supply chains are stressed. Now imagine that scenario playing out not because of a temporary pandemic disruption, but because of a structural shift in how central banks and major investors view gold's role in the monetary system. The COMEX, the major futures exchange where gold is traded, operates on a fractional reserve basis. For every ounce of physical gold in their vaults, there are multiple claims on that gold through futures contracts and other derivatives. That works fine as long as most contract holders settle in cash rather than demanding physical delivery. But if a significant percentage of contract holders start demanding physical gold, the system breaks down. We saw a preview of this in the silver market recently, when retail investors coordinated to take physical delivery of silver contracts. The price spiked, premiums exploded, and the exchange had to change the rules to prevent a default. Gold is a much bigger market, but the same dynamics apply. If central banks continue accumulating physical gold at current rates, and if private investors start demanding physical delivery instead of holding paper claims, the pressure on the system becomes immense. Let me tell you about what happened in 2008, because there are parallels to today that are worth understanding. When Lehman Brothers collapsed and the financial system seized up, gold initially dropped. That surprised a lot of people. Wasn't gold supposed to be a safe haven? What happened was a liquidity crisis. Investors needed cash immediately to meet margin calls and cover losses, so they sold everything, including gold. It was forced selling, not a reflection of gold's fundamental value. But within months, gold began a rally that would take it from $700 to over $1,900 by 2011. Why? Because the response to the financial crisis was unprecedented money printing, zero interest rates, and massive government intervention in markets. Investors realized that the cure for the financial crisis was currency debasement, and gold is the ultimate hedge against currency debasement. Today we're in a similar situation, but on a much larger scale. Government debt levels are higher, central bank balance sheets are more bloated, and the political will to implement austerity or fiscal discipline is non-existent. The only way out is inflation. Either explicit inflation through continued money printing, or implicit inflation through financial repression, where interest rates are kept below the inflation rate, slowly eroding the value of savings. Central banks understand this. That's why they're buying gold. They're not buying it because they think it's going to generate a return. They're buying it because they need an asset that maintains value when currencies are being debased. And here's the thing. When central banks buy gold, they're making a statement about their own currencies. They're essentially saying, we don't fully trust the system we're managing. That's a powerful signal. Think about the psychology of that for a moment. If the institutions responsible for maintaining the value of currencies are hedging their bets by buying gold, what does that tell you about their confidence in the long-term stability of the current system? It tells you they see risks that aren't being priced into markets. It tells you they're preparing for scenarios that most investors aren't even considering. Now let's talk about what this means for gold prices going forward. Technical analysts look at charts and patterns. They'll tell you about support levels and resistance levels and moving averages, and that's useful information for traders. But when you're trying to understand where gold is headed over the next few years, you need to look at the fundamental drivers. And the fundamental driver right now is unprecedented central bank demand combined with constrained supply. When you have a buyer who's price insensitive and accumulating consistently, and that buyer is removing supply from the market permanently, prices go up. It's not complicated. The question isn't whether gold goes higher. The question is how much higher and how fast. Some analysts are calling for gold to reach $3,000 an ounce. Others are more aggressive, predicting $5,000 or even higher. Those numbers might sound extreme, but when you adjust for inflation and compare to previous peaks, they're not unreasonable. Remember, gold hit the equivalent of $3,000 in today's dollars back in 1980, and that was in a world where central banks were selling gold, not buying it. In today's environment, with central banks as aggressive buyers, and with the additional demand from private investors and institutions, the potential upside is significant. But here's what you need to understand. This isn't going to be a smooth ride. Gold doesn't go up in a straight line. There will be corrections. There will be periods where it feels like the rally is over, and that's when weak hands get shaken out. The investors who do well in gold are the ones who understand the long-term thesis and don't get rattled by short-term volatility. They're the ones who view corrections as buying opportunities rather than reasons to panic. Central banks have that mindset. They're not checking the gold price every day and making decisions based on short-term movements. They're executing a multi-year strategy based on their assessment of where the global monetary system is headed. If you own gold, you need to think like a central bank. You need to understand why you own it and what role it plays in your overall financial strategy. For most people, gold is insurance. It's protection against scenarios where traditional financial assets underperform. It's a hedge against inflation, currency debasement, and systemic instability. And right now, the world's most sophisticated financial institutions are telling you, through their actions, that insurance is worth buying, even at record prices. Let me give you another historical parallel that's relevant here. In the 1970s, the U.S. faced a similar situation: high inflation, loss of confidence in the dollar, geopolitical instability. Gold went from $35 an ounce in 1971 to $850 in 1980. That's a 24-fold increase in less than a decade. Now, I'm not predicting a 24-fold increase from current levels. The market is different, the scale is different, and the starting point is different. But the underlying dynamics are similar. We have a fiat currency system that's under stress. We have governments running unsustainable deficits. We have central banks trapped between fighting inflation and supporting economic growth. And we have a growing recognition that the current system isn't sustainable long-term. Gold thrives in that environment, not because gold itself changes, but because the alternatives become less attractive. When you can't trust currencies to maintain their value, when you can't trust governments to maintain fiscal discipline, when you can't trust the financial system to remain stable, gold becomes the default safe haven. And that's exactly what central banks are recognizing right now. The data from the World Gold Council shows that central bank gold buying has been above 1,000 tons annually since 2022. That's 3 consecutive years of record-level accumulation. This isn't a temporary trend. This is a structural shift in how central banks are managing their reserves, and it's accelerating. The fourth quarter data, when it comes out, is expected to show continued strong buying despite elevated prices. What's driving this urgency? Why now? Part of it is geopolitical. The world is fragmenting into competing blocs. The US and its allies on one side, China and its partners on another, and a growing number of countries trying to navigate between the two. In that environment, holding reserves in any single currency becomes risky. Gold is the neutral option. It's not tied to any government or political system. It's universally recognized and accepted. Part of it is economic. Inflation has proven more persistent than central banks expected. The idea that they could print trillions of dollars without consequences has been proven wrong, and now they're dealing with the aftermath. And part of it is systemic. The financial system is more interconnected and more leveraged than ever before. The risks of a cascading failure are real, and when that risk materializes, gold is the asset that maintains value. Central banks are preparing for all of these scenarios. They're not betting on any single outcome. They're hedging against a range of possibilities, all of which point to gold being a critical asset to hold. Now, here's where this gets really interesting for individual investors. You have the opportunity to position yourself ahead of the crowd. Central banks are buying now, but most private investors are still underweight gold. They're still heavily allocated to stocks and bonds, with maybe a small percentage in gold, if any. When the broader investment community wakes up to what's happening, when the narrative shifts from gold as a barbarous relic to gold as essential portfolio insurance, that's when you see massive inflows into gold ETFs, gold mining stocks, and physical gold. And that's when prices really move. We've seen this movie before. In 2008, 2011, gold went from being a niche investment to a mainstream portfolio holding. Billions of dollars flowed into gold ETFs. Mining stocks multiplied in value, and physical gold became difficult to obtain at reasonable premiums. The setup today is even more compelling because you have central banks leading the way. They're providing a floor under the market and signaling to other investors that gold is worth accumulating. The smart money is already positioned. Central banks, sovereign wealth funds, family offices, they're all increasing their gold allocations. The question is whether individual investors will recognize what's happening before the opportunity passes. Because here's the reality. Once gold breaks out to new highs and the mainstream media starts covering it, once your neighbors are talking about buying gold, once financial advisors are recommending it, the easy money has already been made. The time to position yourself is when the thesis is clear but the crowd hasn't arrived yet, and that's where we are right now. Central banks are screaming at you through their actions. They're buying gold at record levels. They're paying premium prices. They're accumulating consistently regardless of short-term price movements. That's not noise. That's signal. The countdown is accelerating because the factors driving central bank buying aren't going away. If anything, they're intensifying. Geopolitical tensions are rising, not falling. Debt levels are increasing, not decreasing. Inflation risks remain elevated, and the trust in the current monetary system continues to erode. Every one of those factors supports higher gold prices, and every one of those factors is why central banks are buying. So what do you do with this information? First, understand that gold isn't a get-rich-quick scheme. It's not going to double overnight. But over the next few years, as these trends play out, gold has significant upside potential. Second, recognize that timing the market is difficult. Trying to wait for the perfect entry point often means missing the move entirely. Central banks aren't trying to time the market. They're accumulating consistently. Third, think about gold as part of a broader strategy. It's not an all-or-nothing decision. It's about having appropriate exposure to an asset that performs well in environments where traditional assets struggle. And fourth, pay attention to what the smart money is doing. Central banks have access to information and analysis that individual investors don't. When they're making a coordinated move of this magnitude, it's worth paying attention. The evidence is clear. The trend is established. The countdown is accelerating. Central banks are preparing for a future where gold plays a more prominent role in the global monetary system. They're not waiting for confirmation. They're not waiting for prices to come down. They're buying now because they believe current prices will look cheap in hindsight. The question is whether you're going to recognize what's happening and position yourself accordingly, or whether you're going to wait until the opportunity has passed and the crowd has already arrived. The data is telling you a story. Central banks are telling you a story through their actions. The question is whether you're listening. Because the countdown isn't just accelerating. It's reaching a critical point where the trends become irreversible and the implications become unavoidable. Gold owners right now are positioned ahead of one of the most significant shifts in the global monetary system in decades. The institutions that manage trillions of dollars are making that bet. The only question is whether individual investors will recognize the opportunity before it's too late.